Global bond yields are on the move again, though not all of them in the same direction. Treasury's once more the odd one out. They're back to selling off, at least at the long end, though we know exactly why that is. We're talking about steepening, and yes, it is the bull kind. So in addition to all of the global markets that we have, we've also got swaps and even the uninversion in the 3-month 10-year spread for the first time in years. Short rates are going down like a bull while long-term rates are going up because Jay Powell doesn't know where he is. It isn't really about the Fed's dots so much as what those represent. And I don't mean the number of rate cuts next year, rather the FOMC's own confusion about how it got here. The reason the Treasury market is decoupled from the rest of the global market, at least temporarily, is entirely Jay Powell's fault, and it won't last forever. That's what swaps have been saying all year and before. And the reality is the Fed is moving in the direction of swaps and the rest of the global market, if only trying to do so on what looks like its own schedule, even if it is simply making everything up as it goes. They call their own confusion data dependence. And in cases where the market data lines up against them, like everything that goes into bull steepening, central bankers have even invented their own math trying to transform bond market reality into something that isn't so embarrassing to them. Even that math, however, ends up making the case anyway because it exposes the real motivations here. The Fed right now says it's not going to cut rates as much. The market says, well, you said the same thing 6 months ago, and 6 months before that you were saying higher for longer. You're moving in the same direction, just not all at once. Nothing ever goes in a straight line. How we get to the end of the line is anyone's guess. But what the end of the line looks like as far as interest rates go, that's everywhere all around us right now, including the uninversion in the 3-month 10-year spread for the first time since late 2022. That happened last week on December 13th. In the short time since it did, the curve has steepened dramatically because short-term rates are going down far and fast. And while it may not seem like long-term rates are, they are in the context of the last couple years. They are lower than they were a year ago. So you have lower longer-term rates overall, but lower short-term rates going much faster than the long end, which is bull steepening. And we've seen this before in exactly the same way during previous cycles. Let's go back to 2001. In 2001, the first uninversion in 3-month 10-year spread happened right away in January when the Fed started cutting rates. But at the time, while the 3-month bill rate was going down, the 10-year Treasury rate was going up. Sound familiar? And then there's the big steepening, the real big steepening in the curve, which happened between March and May 2001 for the same exact reasons that we're seeing here. 3-month rate was going down sharply. 10-year yield was actually going up just as sharply as what we're getting right now. So the uninversion in the yield curve where the long end goes up after going down previously and the short end goes down after being relatively high previously, that's pretty much standard and typical for this uninversion bull steepening process. It happened again in 2007 heading into 2008. In May of June of 2007, the 3-month rate was down while the 10-year was rising, uninverting the curve, but only briefly. It then reinverted over the next couple weeks and then uninverted all over again, where the 10-year was up and the 3-month rate was down September and October 2007 in the period immediately following the Federal Reserve's first rate cut, September of that year. And before we get into the rest of the global market comparisons and something called term premiums, which really betray the entire mainstream point here, I do want to remind you, Eurodollar University, we are having a Christmas sale. It's already begun. Here's your chance to go very deep into the money and macro world, not just about treasuries and curves, but also what's going on in Brazil, what's happening in China, what's the U.S. job market really look like? Well, you have to dive deep into all of these topics to really get a perfect sense, and that's what we do at the deep dive analysis. And here's your chance to get not just the deep dive analysis, but Eurodollar University's AI, a membership, the daily briefing subscription, all together in one exceptionally low price. Check out the details of our Christmas sale at our website, eurodollar.university. One dependable way in which we can check what's going on in the Treasury market is to compare it with other markets around the world. Globally synchronized is not just about the economy. Globally synchronized, especially in the silent depression era of global bond markets. Let's start with Canada. Canada, there's a very close relationship over the last decade between treasuries and Canadian maple bonds, government bonds. There's close correlations in the real economy, Canadian consumer prices, American consumer prices, which is why there's so much co-movement in everything from central bank policies to bond market yields. If you just go back to, say, 2018, you see that one case where we keep coming back to quite often, divergences between, say, Canada and US Treasury yields due to the differences in central bank policies. While they're both doing the same thing at the same time, at that time, the Federal Reserve had raised rates faster and farther than the Bank of Canada had. And when you account for that difference, the yield behavior and the level of yields in both Canada and the United States were actually very similar. In fact, very close to being exactly the same. But then in 2019, what happens? Treasury yields, the Federal Reserve, both of those converged to Canada, while all of them were going down. Fed's cutting rates, the Bank of Canada's cutting rates, Treasury yields are falling before the rate cutting begins, Canadian yields are falling before the rate cutting begins, globally synchronized downturn in interest rates at a time when everyone was convinced interest rates had nowhere to go but up. Instead, we got the bull steepening in the yield curve, all the yield curves, including Canada's. So earlier this year, the two-year Treasury sold off from 4.1% to 5.04% during the first couple months when the bond market rally had paused after the initial leg last year. At the same time, though, Canada's two-year only went from 3.8% to 4.4%, so a much smaller move because the Bank of Canada was more explicit in communicating its intentions for rate cuts than the Federal Reserve, which was back and forth, flip-flopping all over the place, following whatever the most recent CPI was. Uncertainty surrounding the future path of short-term interest rates is being driven higher at these times by confused Federal Reserve officials. The difference between them and, in this case, the Bank of Canada or the ECB, as I'll see in just a second, accounts for the differences in yields. So Bank of Canada is cutting rates and saying we're exclusively focused on weakness in the labor market in particular. And the Fed says, well, we see weakness in the labor market, but our CPIs are going up. We don't really know. You can see it clearly. The difference is the uncertainty about the future path of short-term interest rates that's introduced by the Federal Reserve. Over in Germany, focus on the two-year again. Treasuries had overshot to the downside leading into September compared to their German counterparts, and then they've since overcorrected on the high side by a huge degree. The ECB's policies are coming into more and clearer focus, whereas the Fed's have become increasingly muddy because of the Fed's own behavior. So we see the difference in the fact that German bond yields at two-year maturity, the shots, really didn't sell off all that much in the initial aftermath of the rate cuts, September into October. And since the middle of November, they've been going down pretty sharply and staying there, consistent with the ECB that says we're going to continue cutting rates. And Treasury yields started to reconverge with their German counterparts in the late November and early December, but that's when the confusion over the Fed got reintroduced, scrambling this signal for the future path of short-term rates, and so treasuries are back higher again relative to basically everywhere else in the global bond market. Behind all of that, we've got the interest rate swap market. And swap spreads have been pretty unequivocal on where all of this is going to end up, and that is interest rates that go down, as they're doing right now in the long run, and staying down. It isn't a continuous process. It's not a linear process. Nothing ever goes in a straight line, including rates that want to go lower. But at the end of the day, the swap market has been absolutely sure, as much as any market can be, that's where everything is going. And then everything that has happened over the last couple of years, everything is moving in the direction of swaps, not the other way around, including central banks and the Fed. So to go back to 2022, the 30-year swap spread began to decline even as the Fed was just starting to cut rates. As consumer prices were starting to get really out of control, the 30-year swap spread began to fall, which said that longer run, we're more likely to see rates go down and stay there, even though the central banks, the Fed, the ECB, and everyone else had just started hiking rates. The 30-year swap spread was saying rates are going to go back lower and stay there in the long run. Initially, the 30-year was kind of by itself, but then you had the gilt crisis, which wasn't really about the gilt crisis, September of October of 2022. The 10-year started to fall in line as well, and the 5-year swap spread stuck with the Federal Reserve. But that has shifted over the couple years since then. And the bond rally that got going late in 2023, all of the swap spreads, the 30-year, the 10-year, the 5-year, they were all compressing with that rally. But after we got to the pause in early 2024, the 30-year kept going while the 10-year steadied from there. And then the 5 began to back up, which was decompressing with the Federal Reserve and the dots. So the market started to diverge a bit, saying that the short run swap spreads were, okay, the Fed's going to get its way for the short run. But then the 10-year and the 30-year were saying it doesn't matter over the long run, lower rates are going to happen. Even if the Fed adjusts its dots along the way, over the longer term, its rates are going to go down and stay there. And so the next leg, all of them were lower again in the middle part of the year, heading into July and August and September, and eventually the Fed started to cut rates. But unlike earlier in the year, where the 5-year swap spread actually decompressed a bit with the Federal Reserve increasing confusion and saying it's not going to cut rates as much, and the 10-year went sideways, this time we see all of the maturities, the swap spreads, and all of them continue to stay down. Not even the 5-year's not following the Fed this time. Basically what they're saying is that the long run that the 30-year was pricing back in 2022, we're here in the long run. Rates are ready to go down and stay there. They're going to go down by quite a bit and stay there. Even if the Fed right now doesn't believe it, the market is as strong as ever in pricing that eventuality. And as I pointed out before, nominal Treasury yields have a habit over the last 15, 16 years of following especially the 30-year swap spread. Not that there's a mechanical relationship, but what gets picked up into the swap spread, the fundamental factors that go into them, free from interference from the central bank, they are picking up on the factors that will ultimately, once the Fed gets out of the way, get priced into nominal treasuries as well. And that's really what we're talking about, is the potential for central banks to get out of the way. In the global bond market, Canada and the ECB, those central banks are getting out of the way and doing so in a much clearer fashion than the Fed, which still wants to be on TV, and Jay Powell loves the attention. So they're playing this game of rejiggering the dots and saying they're going to cut rates less next year, when the markets know when all is said and done, they're going to continue on the same path anyway, just not in a straight line. But one other explanation or excuse that you hear for rising long-term interest rates has to do with something called term premiums. And this is something that's come up a couple times over the last couple of years, because for many years, term premiums, which are not real, they're entirely made up by economists, as we'll see in a minute, term premiums had turned positive last year for the first time in many years. And because they had turned positive last year for the first time in many years, last year everybody said this meant that rates were going to go up and stay there. Here's Bloomberg from last September. A key measure of how much bond investors are compensated for holding longer-term debt turned positive for the first time since June of 2021, and it was only positive in June 2021 for a short period of time, underscoring the potential for interest rates to stay higher for longer. That's what all the central bankers said, and so here comes term premiums turning positive, and interest rates did not stay higher for longer. In fact, that article came out a week before the global bond market rally got going. Because term premiums are economists' way to turn the yield curve behavior around in the Fed's favor. A term premium is supposed to be the additional yield that investors demand to hold for lending at longer term. If someone wants to borrow at 2 years, you're going to charge them an X interest rate to do so. If they want to borrow from you for 3 years, you're going to charge them a little bit more for that extra year. That's supposedly the term premium. And it sounds perfectly reasonable and plausible and intuitive, but the way in which it's calculated, as well as what it's supposed to represent, is nothing of the sort. It's simply the fact that term premiums don't ultimately make sense because their whole purpose is to introduce a set of mathematics to turn the bond market completely around so that it doesn't contradict the Federal Reserve in economics and econometrics. Instead, it's using that math to reinterpret yield curve behavior in a way that's friendly to all of those, especially the Federal Reserve. That's all it really is. And we can see that going back to the 2000s when term premiums really became a thing. Alan Greenspan's conundrum. His conundrum was nothing more than the fact long-term rates were not doing what Alan Greenspan thought they were going to do. And so the flattening of the yield curve in the middle 2000s, if you take it at its face value, which you should, the flattening yield curve was simply the bond market not buying the story that the Federal Reserve was, that the economy was behaving in a way the Federal Reserve thought it was. The Fed thought things were really good and becoming inflationary. The bond market was saying, have you seen this housing bubble? It's going to be deflationary, which was the correct position. So the Fed introduced, and economists introduced the concept of term premiums, which flips the flattening of the yield curve on its head. It says that the flattening curve is not a straightforward warning as it really should be. Instead, what that means is that investors are demanding less of a premium to lend it longer term. That means that investors are more optimistic about conditions in the real economy. Therefore, Alan Greenspan was right. They took a flattening yield curve, applied some math to it, called it a term premium, and completely reinterpreted what was a straightforward signal. And the funny thing is, their calculation for the term premium, the models that they use, is really nothing more than the 3-month 10-year spread. When you put the two together, they line up almost exactly. So you can say, again, it's so transparent in the purpose here. It's to apply some complicated mathematics in order to completely transform an unfriendly signal into one that is friendly. And it was used in the same way in the middle 2010s, the silent depression. Throughout the 2010s, the term premiums were low because the yield curve was flat in that entire period. And the yield curve was flat because short-term interest rates were zero and growth and inflation expectations were falling, a negative signal. But when you apply the math of term premiums, you say, no, that's not a negative signal, that's a positive signal. It actually means that QE works. And because term premiums were falling, that means investors were demanding less of a premium to lend at longer terms. And of course, that's complete garbage. And it became complete garbage and became completely obvious that it was complete garbage when the term premium turned negative. More recently, we can look at term premiums that are becoming positive again, which means they're rising, which is nothing more, again, because it follows the 3-month 10-year spread, which is bull steepening, not a good sign there. But according to term premiums, that means that investors are demanding additional return to lend at longer terms. Therefore, they must need compensation for some risk, either inflation or, as many people point out, this must be the U.S. government and its massive deficits. So they're trying to flip the bull steepening in the yield curve into something else entirely. Something else that, like the article said last September, is going to lead to rates going up and staying there. When, as we saw last year, as the bond rally instead developed, term premiums are not really a thing. They are nothing more than a transparent attempt to muddy the water where it comes to very straightforward yield curve signals. Bull steepening is what bull steepening appears to be. So we've got rising Treasury yields at the long end, really the middle part of the curve and the long end, the 2-year out to the 10-year and beyond, because Jay Powell can't make up his mind right now. But as the rest of the global bond market has no trouble because they don't have the same level of central bank interference, or the swap market, which says that rates are going down and going to stay there no matter if they don't take a straight line path to get to that eventuality, that's where they're going. And the swap market is even more confident about that today than it was a year ago or 2 years ago when it first started to develop. The problem is Jay Powell, the FOMC. They cannot interpret either consumer prices or the labor market and make sense of it in a way that apparently other central bankers have been able to. So the bond market is performing as we've seen in other cyclical periods like 2001 before the dot-com recession or 2007, 2008 before the Great Not Recession. The bull steepening does entail short-term rates going down faster than long-term rates, but long-term rates may not be going down the entire time either. They go back and forth as well. But short-term rates have a lot longer to go, a lot farther to go, especially in this cycle, so we'd expect them to make a bigger move as they've done. Once the Federal Reserve gets itself out of the way, in the same way in which the ECB and Bank of Canada are already doing, then you have convergence. Convergence with swaps, convergence with maple bonds in Canada, with bunds, with the downside of the supply shock. Speaking of the downside of the supply shock, the utter collapse in the short end of China's yield curve. That's where it's coming from, and that's the video I've got linked below. As always, thank you very much for joining me. Check out Eurodollar University's Christmas sale. Huge thank you, Eurodollar University members and subscribers. And until next time, Merry Christmas.